As a new administration prepares to take over Washington in the new year, tax reform has become a top priority for Republicans. But there's a significant difference between President-elect Donald Trump's tax plan and the proposal set forth by House Republicans. And as you know, they have to work together to get things done. Right now, everyone is scrambling to figure out what it means for taxpayers. So here to help explain the details is WSJ's tax reporter, Richard Rubin. Thanks for joining us, Richard.
Yeah, good morning.
So before we get into the weeds on this, let's just recap the areas where Trump and these House Republicans actually agree. What aspects of tax reform seem like a sure bet?
Well, nothing is a sure bet in tax reform. That's the first rule of tax reform. But look, here's where they agree. They agree that rates should be lower for businesses and for individuals. They agree that businesses where the owners pass the income to their individual returns, partnerships, LLCs, those kinds of things, should get a lower rate than wages. They agree that the estate tax should be repealed. They agree that some tax breaks should go away. And so you've got that general course of agreement there, but there's still some areas where there's either a lack of agreement or where you've got some ideas from the House that really haven't got, where President-elect Trump hasn't taken a position at all.
Right, and one of the big differences, and one that's causing a lot of confusion, as you write about, comes from the House Republicans' plan. They are calling for a border adjustment tax, what does that mean?
Okay, so what that means is this. The idea is to make the U.S. tax system more like the value-added taxes in other countries. Now, that's not what House Republicans say, but that's in practice partly how it would work. The idea is that when taxes would be based not on where income is earned, which is sometimes dependent on where profits are, where a company's headquarters is, where its patents are, but it'd be based on where items are sold. And so the final sale will determine the destination. It's called destination-based, and that's where the tax would be based from. So anything sold outside the U.S., exports, for example, or products that U.S. companies are making overseas wouldn't be subject to U.S. tax at all. So exports are exempt from U.S. taxes under this plan. And then imports, to make it fair and balanced, anything coming into the country, imports would be taxed at this new lower rate of 20%. And so it would mean that, technically, like, you wouldn't be able to deduct the cost of those imports if you're a company. And so that has some really big effects. And what that means right now is companies are trying to understand it. Importers, big retailers, Coke Industries, oil refiners, are really concerned about the effects of this proposal on the cost of imports. And you've got Republicans and economists saying, no, it's not going to be a problem. The dollar will rise and offset that tax change. So if exports look cheaper because they're exempt, really they won't be after this all washes out.
It's so confusing. And I also want to point out in your article, you mentioned Jefferies analysts call it a radical departure for U.S. tax policy. Capital economists describe it as equal parts genius and crazy. Cohen says this could create cliffs of insanity. Those are some strong words. Why so controversial? Does this have any chance at all at actually becoming law?
So it's controversial because it's so different. It's changing the way we think about how U.S. corporate taxes are based. Like it's a really radical change. Think about it, all the things we've been talking about in the tax system for the past few years, like inversions, where a company takes its headquarters, its main office, and puts its address in another country, and all of a sudden they can lower their U.S. taxes. Well, that doesn't matter because the taxes here would be based on sales. Same thing with sort of moving your patents and intellectual property offshore. That, in a large fact, wouldn't matter because if you're selling back into the U.S., then you have to pay U.S. taxes. So it has some real attractiveness, but it's so different, and they haven't released a bill yet. It's just this like 30-page blueprint that everyone is really trying to figure out what it is. And so can it pass? I don't know. What House Republicans say is, look, Trump's out there talking about tariffs. This is tax reform. They say, like, this is a better way, which is their plan, right?
The mantra.
What they say is, like, this is better than tariffs because tariffs are only on imports. This is sort of even because the same tax would apply to domestically made products. So they're pitching it, but there's going to be a lot of opposition. There's already a lot of opposition from companies. The Senate hasn't weighed in yet. Trump has given some signals from the incoming administration, but haven't taken the full measure of it yet. And so that's what we'll be watching in the new year, is what sort of resistance this plan runs into.
Yeah, it'll be interesting to see how this plays out. Richard, thank you so much for joining us.
Yeah, thanks.